and go ahead and jump in. I'm going to share my screen, and we'll go ahead and get started. Just some logistical matters, and I believe my screen should be shared now. Brittany, can you nod to make sure? Yeah. Okay. And we'll go ahead and make sure that's full screen. These slides will be posted in an article that's going to come out hopefully later today, and this is a recorded session. But my email will also be at the end, and so you can go ahead and email me if you have any specific questions. But again, I've been giving this talk out to a lot of folks, and so I'm happy to travel out or do other Zoom talks as needed. So just to go ahead and start out with where we're going to be going with this, most of this is going to be based on changes from the official name of the Big Beautiful Bill. There's going to be new above the line deductions as well as changes to the standard deduction. If you're not familiar with what that means, we're going to go through just some very brief terminology discussions as to what that means. I teach tax students who have not had any prior tax knowledge. And so don't worry, you're not like, I don't know what above the line versus below the line means. We'll go through what that means. And then we'll go through some changes to taxing on the investment side of things with Section 179 and bonus depreciation, as well as changes to the estate tax exemption, because that's one I noticed a lot of people are worried about. Both my tax talks and my estate and farm succession talks. There's good news on that front. So don't worry, things are getting better for farmers on that front. And then we'll end it just with some tax strategies, because again, this is meant to help you and other people in their farming practices, and just to give some updates to ways you can plan around the changes that we talk about here. And so we'll go ahead and get into the terminology part of it. This is a slide I'll refer to a couple times during this presentation. This is how you calculate the amount of income taxes that you owe. This goes for both your business taxes and any, W-2 salary you might be making on the side. If you're, say you're a school teacher, but you're also teaching or you're also raising cattle on the side, which is a pretty common setup that I've seen. And so you take your gross income, which is any money that comes to you that's not a gift. And so that's your W-2 salary, that's any income to your farm, that's any 1099 income that you have. Any money that's coming to you in exchange for services or products is gross income. And then you take out from that your above the line tax deductions. Now, to be clear, because this is one of two types of tax deductions, anybody can qualify for above the line tax deductions. You might say, well, I take the standard deduction. Even if you take the standard deduction, you still get above the line tax deductions. Once you take out your above the line tax deductions, you get your adjusted gross income. We call that your AGI. And then from your AGI, you have a choice. You can either take the standard deduction, which is what about 90% of people have done in the past 8 or 9 years since the previous tax bill, or you can itemize, or what's commonly referred to as itemizing, but it's actually taking below the line tax deductions. But you have a choice. And because it's a deduction, you want to choose whichever the choice is bigger between the sum of all your itemized deductions or the standard deduction. And from that, you get your taxable income. At that point, you take out any tax credits and you apply your tax rate as applicable, and then you get your actual income taxes owed. Again, I know that's a lot. We'll refer back to this as we need to, but we're just going to go down the list. And so first, we're going to talk about these above the line tax deductions and changes that we've gotten to these. And so again, these are deductions that anybody can get. And so if you're a taxpayer, you qualify for these, no matter if you're itemizing or not. So the first one is what is officially referred to as the senior bonus deduction, but a lot of times you're seeing it on the news as the no tax on Social Security. And so it's not technically removing taxes from Social Security specific payments, but it is related to age, which is correlated with Social Security, obviously. And so just because you haven't started filing for Social Security yet, if you're in that boat, you can actually still qualify for this, which is a pretty interesting aspect of it. And again, available to itemizers and people who take the standard deduction because it is above the line. Now, previously, and was in existence before the Big Beautiful Bill was passed, there was a specific tax deduction for taxpayers over the age of 65 years old. For individuals, it was $1,000. For married couples who filed jointly, it was $2,000. That one is in place. It's been in place before. It'll be in place after this tax deduction sunsets out. because as we'll see, this tax deduction is going away, at least according to the latest legislation. They may change that, but unless something changes, it will go away in 2029. And so what happened with the Big Beautiful Bill was it's increased by $6,000 per taxpayer. And so if you're an individual that's over the age of 65, from 2025 to 2028, you can have up to a $7,000 tax deduction. But if you're a married couple from 2025 to 2028, and both of you are over the age of 65, then it's a $14,000 tax deduction. Now, importantly, there's a 6% phase out for every dollar that's over, if you're an individual, $75,000 of your modified adjusted gross income, or if you're married, for your combined income of $150,000. So if you're making, say, $350,000 in a given year, first, congratulations. That's awesome. You're having a good year. Second, this is assuming you will not be getting the extra $6,000 or $12,000, depending on if you're married or not. You're still getting that 1,000 or 2,000. That's not income adjusted, but this additional $6,000 per taxpayer is what is being adjusted based on this. And so, to put it in one sentence, for taxpayers over the age of 65, from 2025 to 2028, you're getting an extra $6,000 in tax deduction per taxpayer if you're married, um, assuming your income is below 75 or 150. So good news for taxpayers in that specific time frame, but again, it will expire in 2029. The second above the line tax deduction I wanted to talk about was a pretty interesting one based on charitable givings. This is like tithes to your church. This is donations to NC State. Please put on the memo line Nicholas Brown so that I look good and for my bosses and the review at the end of the year. And so previously, charitable giving was only a below the line tax deduction. And if you're itemizing, it still is. And so there's a floor on that now where you have to give at least 0.5% of your AGI to count as a charitable deduction. Anything below that, that's not going to be deductible. But if you're taking the standard deduction, as an individual, you can get up to $1,000 tax deduction, or if you're married, you can get up to a $2,000 tax deduction. And so this is really meant to hit on the folks who are not itemizing, which is you don't have a huge property tax bill, just relating to farmers here. If you don't have a huge property tax bill, if you're not giving, $60,000, $70,000 plus in charitable donations, and you're only taking the standard deduction, you can get up to a $2,000 tax deduction. So this is sort of meant for like the standard family in a rural area that doesn't have a huge property tax bill, that is, tithing to their local church. That is what this is intended for, to be able to incentivize some amount of charitable giving so that it takes away from your tax bill at the end of the year. Not a huge tax deduction, but previously charitable deductions had taken a pretty big hit in recent years. And so this is meant to incentivize that and to give you a tax deduction for it. All right, so those are your two above the line tax deductions that have been changed by the Big Beautiful Bill. So again, that's the senior bonus deduction or the no tax on Social Security and the effects to the charitable giving, like we just discussed. Now we're moving into whether or not you're taking the standard deduction or the below the line deduction. And there's some pretty good news for farmers on this front because previously about 92 or 93% of taxpayers were choosing the standard deduction. And the standard deduction is actually going up from the Big Beautiful Bill. So previously it was set to go from $15,000 and $30,000 in 2025, and it was going to be reduced by half because parts of the previous tax legislation were phasing out. And so they were going to go down to from 15,000 to 8,350 and from 30,000 to 16,700. That's cutting in half, but adding an inflation adjustment. Instead, now we've actually got an increase in the standard deduction for 2025 for both individuals and married couples. So we went from 15 to 15,750 and from 30 to 3150 or 31,500. And those are now made permanent. So the standard deduction is going to stay at its doubled rate permanently. Again, Congress can always change that, but there's no set in expiration date. And there's an inflation adjustment for future years. So you might be thinking, well, I've been taking the standard deduction for the past 7 or 8 years since the Tax Cuts and Jobs Act increased it. Um, why would I not just continue taking the standard deduction? And you might still do it, but there was one major change that's going to affect, especially farmers with cattle, because you tend to need more land for this. It's not like, an orchard where you can have a small orchard that's, 5 or 10 acres. Cattle tend to need more acreage than, say, poultry farms. Again, all things equal. But there's an increase to the salt deduction. And so, to give some history on this, prior to 2017, the SALT deduction, which is a deduction for your state and local income taxes and property tax too, um, was unlimited. So if you paid $50,000 in property taxes and state income taxes, then you would never take the standard deduction because your standard deduction would be, $10,000, $15,000 as a married couple. Um, because that's before the Tax Cuts and Jobs Act doubled it. But you have had a $50,000 deduction from your SALT cap. In 2017, there was a cap put on the SALT deduction, $10,000. So it wouldn't matter if you paid $50,000 or $500,000 in state income and local property taxes, you were only capped at $10,000. Now, the Big Beautiful Bill adjusted this and it made that cap go from $10,000 to $40,000. But it only applies that cap from 2025 to 2029. And in 2030, it's going to revert back to $10,000. Now, there is an income threshold on this. It's a very high income threshold. It's $500,000. And these numbers are inflation adjusted. And so I'm not going to speak to folks that are over $500,000 in income. But if you're paying a high amount of property taxes, which tends to be what the farmers tend to be paying the most in, at least in North Carolina, because our state income tax is not super high. This salt cap is probably going to be what makes most farmers end up um, choosing to itemize instead of taking the standard deduction. Because even if you're married, your standard deduction is 31,500, but you can take a salt cap of up to $40,000 for the next 4 years. Again, that's going to revert back in 2030, but that's where we're at right now and for the next 4 years. All right, so the salt cap is the big one on the standard deduction, but the standard deduction itself is also changing. I'll throw this in there just because it's worth mentioning because I've met most of my audiences. Most of them are parents and have kids. The child tax credit is changing. And so again, the tax credit is a one-for-one exchange. If you were going to pay $1,000 in income taxes on the year and you had a $500 tax credit, well, then you're only paying $500 in taxes on the year. So tax credits are the cream of the crop. They're better than deductions. And so the child tax credit used to be $2,000 and it was a flat number. There was no inflation adjustment. And that was for every child under the age of 17. Logic being, if you're 16 and under, you're probably not able to get a job. But if you're 17 or over, you can get a job if your parents really need you to get a job. And so it used to be $2,000. Now it's $2,200. Now that's only a 10% increase. That's not super notable. The important part, though, is it's now indexed for inflation. And so that is going to be great in future years because as inflation continues to go up and causes the value of the dollar to go down, your child tax credit will reflect that. They've also increased the refundable amount. And so if you have enough in tax deductions and tax credits, you can get up to $1,700 per child back. Um, you do need to have a certain level of earned income. It has to be $2,500 for there to be a refundable credit. Um, but again, this is good news for parents with children. There is a phase out for married couples over $400,000 in earned income on the year. Um, but again, for most folks, this is good news if you have children. All right, so that is our annual income tax deductions and credits talk. Now we're going to move over to investments and assets. And so before we talk about this, just like how we were having to talk about how to calculate your income taxes, we have to give a brief discussion on basis. And so what basis is in one sentence, it's how the IRS views the value of property. And so Basis itself is the amount of investment in property, and it's usually calculated by giving adjustments to it. So your adjusted basis is usually calculated as your initial cost. So if you buy a vehicle and it's $50,000, that's a $50,000 basis starting. But then you can add improvements to it. So say if you buy a truck and you add a winch to it, then that is a $3,000 improvement to that vehicle's asset or basis. And then you can add the labor cost to it, but then you depreciate it. And this depreciation is important because this is a deduction every year on your taxes. The one thing that I always like to note is that adjusted basis is not always and it's rarely the same as your fair market value. This came up with a lot of the hurricane and lien tax questions that I got, where people would say, "Hey, I had a vehicle get washed away in the storm. It was a 2-year-old vehicle. I depreciated it 100% in the first year. What can I get as a tax deduction for that? Because the vehicle before it got washed away was probably worth $40,000, for example. But they had adjusted it all the way down through depreciation, and so the IRS's perception, it was worth nothing. And so, as cruel as it is, the IRS said that taxpayer lost nothing when that happened. And so, point being, your adjusted basis is usually lower than your fair market value because you can depreciate things quicker than they're actually going down in value. It's a rough math, but you get unfortunate results like that sometimes. Section 179 is a very popular provision for CPAs to use with their farmers and other small businesses. And so typically when you buy an asset like a vehicle, it'll have a usable life of 6 years. Now the IRS is the one setting that usable life. This is not something that you can tinker with. So the IRS says that vehicles under a certain weight class have a usable life of 6 years. Let's say you bought that vehicle for $60,000. And so for each of the next 6 years, you get a $10,000 tax deduction. That's your standard depreciation method, straight line depreciation. Section 179 allows certain businesses, farms included, to depreciate the full amount of that qualifying asset in the first year. So instead of going $10,000 in year one and then another $10,000 in year two, all the way out to year six, where you get your last $10,000 deduction, you get the full $60,000 deduction in the first year of the purchase. And so that's through Section 179. What assets qualify for this? Well, most of them do. And so any tangible personal property qualifies as an asset here. And so that's your vehicles, that's your single purpose buildings, that is any equipment that you buy, tractors, attachments for the tractors, combines, things like that qualify. So large investments do qualify, as well as small investments. The two major ones that farmers need to realize do not count as an investment for Section 179 is general real estate. And so if you just buy a large tract of land, you can't appreciate that because the IRS recognizes the reality that land almost always goes up in value. So it's not depreciating, it's appreciating. It also excludes multi-purpose buildings. And so just to give a distinction here, like a greenhouse, that would be a single purpose building. But a barn that you have some cattle on one side and a tractor being stored on the other side, that's a multi-purpose building. And so do realize if you're looking at buying a building and using this, you need to be a little careful with how you're going to be using it. All right, so here's the brass tacks of it though. In 2025, before the Big Beautiful Bill was passed, you had a maximum deduction for an individual asset acquisition at 1.25 million. And your maximum investment limit, meaning you could buy multiple assets, was 3.13 million. The Big Beautiful Bill changed that. They doubled the maximum deduction for a single asset to 2.5 million. This is good for farmers who need large assets like tractors and combines that can run over that amount. And they adjusted the maximum investment limit from 3.13 to $4 million. And importantly, you'll notice they added inflation adjustments for future years. This is not one of those things that's going to sunset out. This is now permanent. And I say permanent always with a condition Congress can change it, but they haven't predetermined the date that it will be changed, that they would have to go in and write a new bill to change it. And so that's where we're at on this. The practical takeaway from this is that if you're looking to buy individual assets that are over 1.25 million but under 2.5 million, you can get a better deduction from it. And if you're looking to buy up to $4 million in assets, you can get a better deduction, at least in the first year. So this is really important for beef farmers right now because the prices of beef, I know it's a little controversial in the last week because of tariff news and other things that are coming out. But the price of beef, most beef farmers have been having good years. And so if you need to offset that income, Section 179 can help that this year. You don't have to wait till next year to add new deductions into that. The second half of this is bonus depreciation. Bonus depreciation is a relatively new thing in the tax code. It is something that it was created in the 2017 Tax Cuts and Jobs Act, um, but it is similar to 179, but it adds an additional 100% of deduction for assets that have a useful life of 15 years or less. And so you can go from if you bought a greenhouse and it was a $500,000 greenhouse, you could get a $500,000 deduction under 179, and then an additional $500,000 deduction under bonus depreciation rules. So you get up to a $1 million deduction for a $500,000 asset. Now, we did have bonus depreciation from the Tax Cuts and Jobs Act, but it was set to sunset, meaning that you could only get up to a 40% on your depreciation for that. And it was set to expire next year or in 2027. Um, Now, what the Big Beautiful Bill did was it made permanent, um, jumped ahead a little bit too much there. It made permanent bonus depreciation at 100% rates. And so it can be used alongside Section 179. So again, if you're buying like a $500,000 asset, you can get one $500,000 deduction under 179 and a second $500,000 deduction under bonus depreciation. And it's not going to expire. This is made permanent in the tax code. And importantly, and unlike Section 179, you can get a loss. And so I don't have the math on this page, but let's say you had uh, an income of $500,000 on the year, just to keep the example going, and you bought that $500,000 asset, well, the Section 179 deduction will take your income from 500K all the way down to zero. But bonus depreciation will give you a loss of $500,000 at that point, and you can carry that loss forward to future years. And so this is great for farmers looking to add investments on the farm, looking to upgrade their machinery, to add certain buildings. Again, talk with your CPA before you go about, making a huge investment in a building and only to realize it's one of those few building types that don't qualify, specifically those multi-purpose buildings. But generally speaking, your machinery, your vehicles will qualify under this. Okay, so again, this is something that applies with basis. And I've had a lot of Hurricane Helene materials up. If you're still struggling with issues there, shoot me an email. And I can send you the materials that we've got up because I've got pretty extensive articles about it. But these are lessons that I've learned in my first 2 years at NC State about basis and depreciation when it comes to natural disasters and other situations. And so if you depreciate your assets 100% in your first year, um, the what's going to happen is the IRS is going to have a basis of zero at that point. And so if you sell the asset in a second year, well, then any proceeds from that sale are going to be considered ordinary income. So if you buy a truck for $60,000, and you depreciate it all in 2025, and then you sell it next year for $50,000, well, that's going to be an ordinary income of $50,000. And so just watch out for that. Do realize that, basis can have effects on your income in future years if you depreciate everything all the way down. And if you're wondering why I keep referencing Hurricane Helene in this, it's because some people had insurance on their assets that they lost in Hurricane Helene. And so one of the common things that I would see is people would come to me and they say, "Hey, I need to figure out how to calculate this loss. This asset got washed away in the storm, and I'm getting insurance proceeds either this year or next year for this. How do we do the math here?" And they would be expecting me to come out and say, like, "Hey, your loss is this, your deduction is this." And I would have to give them the unfortunate news. you depreciated all of this 2 years ago and it has a basis of zero. And so not only are you not getting a loss, you're getting ordinary income from those insurance proceeds. Again, there's tools to mitigate that. But just letting you be aware that if you depreciate all of your assets in year one, there can be some dangers to that. Do be aware of this when you're depreciating things and using certain rules. And so um, we'll keep going through this. Now to estate taxes. And so estate taxes are a topic that a lot of people get very confused and concerned with. And so hopefully I can clear all this up pretty quickly, because it's not nearly the topic to be afraid of that most people think that it is. So estate taxes are commonly referred to as death taxes or inheritance taxes. And so to break it down to be a little bit more understandable, estate taxes come from the IRS, so they're federal. Inheritance taxes are imposed at the state level. Only a few states, I think it's seven, even levy inheritance taxes. North Carolina is not one of those states. Um, I think Virginia is considering an inheritance tax right now, in their state legislature. But the nearest state that I think that has an inheritance tax, I think is Kentucky. And so most of our farmers, even if you have land in surrounding states, do not have to worry about inheritance taxes. The only one you have to worry about is estate taxes. But as we go through this, you'll see you don't have to worry about estate taxes either, more than likely. And so again, this goes back to basis. Um, and I'll run through some examples because a lot of times people will try to avoid the estate tax by giving things to their children before they pass away. Some of the strategies we're going to talk about involve ways to do that without unnecessarily hurting things with your basis. And so again, basis is the amount of investment in a property as perceived by the IRS. The amount in basis is the basis of a property that the IRS perceives as you having. So again, I'm kind of just saying the same thing. It's usually just the amount or the AB of the property that was there when you assumed control. So like if I bought a house for $200,000, then that house has an amount and basis of $200,000. Now it can be increased. Say I bought a piece of land for $200,000 and then I built a $300,000 house on it. That land now has a basis of $500,000 because it's 200 in the land, 300 in the house. And then there's amount realized, which is the amount realized if I'd sold the property. So I've got that piece of land with a house on it. It's worth I bought it for $500,000. And then I sell it 2 years later for $600,000. So my amount realized is $600,000. We calculate my gain or loss by calculating the difference between the amount and basis and the amount realized. So that's 600 minus 500. And so I would have a gain on that hypothetical sale of $100,000. And so if you're wondering why I'm talking about that, that's where we get our long-term capital gain tax. And so this is important when it comes to the estate tax. And so just footnote this. Importantly, though, if my dad had bought a piece of property and he had bought it for 200,000, built a $300,000 house on it, and then when he passed away, he gave it to me and it was worth $600,000, I would take an amount and basis of $600,000, not $500,000, because it's a stepped up in basis. That's one of the rules that the IRS has. If you give somebody a piece of property through a document related to your passing away, so either will or intestacy or even a revocable trust, you get a step up in basis. This is really important because you can have negative consequences when you don't get a step up in basis for several generations, and you can end up paying too much in capital gains tax. And so we'll go through some examples because that's really convoluted. I'm not going to sit here and pretend like that wasn't a lot of words with very little examples. And so we've got a mom and dad, and they buy a house for $100,000. Wherever you can find a house for $100,000, good luck. I probably need to update these numbers. Their amount and basis is $100,000. And so we're going to keep building on this. And so they sell that same house 20 years later for $200,000 to buyer. Now, buyer is a third party. It's not like their child or a son or their parents. It's somebody that's just new to the town. Mom and dad have an amount realized of $200,000. Now, what's their gain? Well, to calculate their gain, it's their amount realized minus their amount in basis. And so 200 minus 100 equals 100. They have a $100,000 gain that they may need to pay capital gains taxes on. And the buyer is taking an amount in basis of $200,000. So when he sells it later or gives it to his kids, that will be relevant to them. Now let's walk through the same example, except they're gifting it to their child while the parents are still alive. And again, this is all going to relate back to estate taxes, and I'll show you why in a minute. And so mom and dad decide they're going to downsize and they want to gift their house to their child. And so the fair market value of the house is now $200,000. The son receives the house for free, or it doesn't matter if it's for free or for 10,000 or 20,000. It's as long as it's under the original amount and basis, the son is taking the amount and basis that his parents had because it's $100,000 as a basis, and he's getting either a sweetheart deal or the house for free. So he's going to take their amount and basis of $100,000. Now, if the son decides to help sell that house 5 years later for 250, what's his gain? Well, it's 250 minus 100, and so the son is going to get a capital gains tax on $150,000 in gain. And so your long-term capital gains tax rate varies between 0 to 20%, and fair warning, it goes up 20% pretty quickly. And so that's it in a gifting scenario where you give something to a child before you pass away. Let's go through the inheritance side of it. So they do the same thing. It doesn't matter if it's with a will or a revocable trust or intestacy. They decide that, hey, my son's going to get this house after we pass away, and they pass away 5 years later. Well, the son is now going to get the house with an amount basis of $250,000. And so the son now decides to sell that house, and his amount realized is 250, and his amount in basis is 250. So he's not going to have any gain, and so he's not going to pay anything in capital gains taxes. Again, this is an important distinction between because in the previous example, he sold it for 250, the same exact price, and had to pay capital gains taxes on $150,000 in gain. Whereas in the inheritance example, he sold it and paid no capital gains taxes. So important distinction, which is why we tell people to not give property to their children before they pass away, which relates back to estate taxes. So how are estate taxes calculated? Well, they're levied on the value of the decedent's gross estate over the exemption amount. So if you're under the exemption amount with things in your gross estate, you're not paying anything in federal estate taxes. But what's in your gross estate? So anything that's a beneficial interest, so if it's in a revocable trust, that's in your gross estate. Anything property-wise that has your name on it, that's in your gross estate. Any tangible personal property, so like tractors, vehicles, things like that, in your gross estate. The other one that often gets tripped up is anything in an LLC or an S corp or a C corp, that's in your gross estate. And gifts made within 3 years of your death. It's common for folks to think, hey, I'm just going to be on my deathbed and I'm going to write a deed to my child. That's not going to count. That's going to be included in your gross estate. And so that's not a valid way to evade estate taxes. And so most anything other than irrevocable trust is going to be in your estate tax or in your gross estate, which estate taxes are levied on. Now, what is the gross or what is the estate tax exemption? Well, in 2025, it was going to be anything between 13.99 million for individuals and anything under 27.98 million for married couples. That's a very large amount of assets. Most people are not over this amount. If you are, it's worth looking into certain estate planning tools. But fair warning, those estate planning tools tend to be significantly more expensive if you're over this threshold, like tens of thousands of dollars a year expensive, not something you want to do as an insurance policy unless you know you'll be over this. But the 2017 Tax Cuts and Jobs Act was set to expire on this increased amount. And so in 2026, it was going to be $7 million for individuals and $14 million for married couples. Now, this is a significant cut. There's a lot of people in between the 14 and $28 million range that were going to be caught in this halving of the estate tax exemption. And so in the Big Beautiful Bill, they went from in 2025 going from 13.99 to 15 million for individuals and from 27.98 million to 30 million for married couples. And importantly, 2026 being the big distinction, they made that doubling of the estate tax exemption permanent. And so this is not one of those things that's going to sunset. This is now $15 million for individuals, 30 million for married couples with an inflation adjustment. So what this means is that most farmers in the state of North Carolina are not going to be paying estate taxes. The ones that are, and they're usually married couples, just from the ones I've spoken to, um, are going to be in the 30, 40, $50 million range of total assets. Now, land prices are increasing a lot in North Carolina. That's nothing to sneeze at. But for the most part, the estate tax exemption cuts out most farmers from having to pay estate taxes. Point being, unless you're just way over this, don't worry about having to pay this. Worry about keeping your farm out of probate after you pass away, which tends to be a lot more expensive process than most people think. Now, if you are over this, if you are over that $30 million mark, the amount of the estate tax is usually about 40% once you get over $1 million. And so if you've got $32 million in assets, you're going to be paying roughly $600,000 or so in taxes because you've got this build up to it and you've got 40%. And so it's a lot, it's pretty heavy tax being levied there, but most people aren't having to pay it. Now, one of the common questions that I've gotten when I do this talk is, well, what if I pass away in 2025 and my spouse passes away in 2026? It's whatever the estate tax exemption is for the year that the second spouse passes away in. And so don't worry, you only have to worry about 1 year. You have to worry about when the second spouse passes away. All right. So now we're going to move into strategies based on things we've seen in these changes from the Big Beautiful Bill. And so the first one, I've got an article coming out about this, and it will be posted on the website that I send out. It's taking a lot longer than it should to post that article, but I don't have control over that. That is to, if you have children, to employ your children. And the things you have to realize here is that your children are likely to have performed some kind of service on the farm. The IRS generally recognizes that kids as young as 6 or 7 years old can perform some sort of farm labor. Importantly, and more than likely, you're in a higher tax bracket than most, or if not all of your children, meaning that every dollar you earn, you're paying more on taxes on it than your child would if they were making that same dollar. But you're running a business, and so you have a payroll tax deduction, and you have a 1099 deduction for any expenses you pay to contract labor. And that's true of any employee that's in your business except for your owners. And so if you're running a single member LLC, any payment that you make to yourself, that doesn't count here. It's only to non-owners that this counts for, like your children. Now, parents often gift money to their children. That's not a tax deduction. And so you can't just give them money without them doing any exchange in labor and get the tax deduction. But you can pay them for the work that they're probably already performing. And since they're in a lower tax bracket, you, as the higher taxpayer of the family, would be getting a tax deduction. That's good for you. And they would be getting an amount in salary that they're probably not paying taxes on because, again, the standard tax deduction is $15,750 for your children. So the big picture here is to employ your children, give them a 1099 at the end of the year, teach them how to pay taxes, but realize they're not going to be paying anything in federal income taxes because of the standard deduction being as high as it is. Now, they will pay a little bit in self-employment taxes, that 12.4%, but that's still lower than most ordinary income tax bracket that you're in, and you'll get a tax deduction for paying them. And so, on the whole, I tend to think as the family is one big bucket of money that's coming in, more money is staying within the family and being paid less in taxes, but the children are still doing the same work they were before. Now, the one caveat that I have to give to this, again, the standard deduction is 15,750. Do realize your children might not be doing $15,000 and 750 of labor in a year. If it's just a 6-year-old and they're helping set up the farm stand, every weekend with their grandfather during fall harvest season, that's probably not worth 15,750. But if you've got a 17-year-old that's, coming home every night and, feeding the cattle and working the tractor and cutting hay, that you're getting close at that point. I mean, you need to use reasonable estimates on what they would make in the free market. And so think about what you're paying other farm hands and use your judgment call there. Your 6-year-old probably can't make 15,000 in a year, but your 17-year-old might. And so use reasonable salary figures there. And again, you have to use 1099s for this. There will be a self-employment tax, but there will be less that you're paying in ordinary income taxes. So the second one is a topic that I've hit on a lot already. Most people think that farms are lost due to estate taxes because they call it a death tax and they get really afraid of it. But typically, farms are lost in the colloquial sense, somebody else bought them out because it's in probate and it's very hard to get things out of probate, very expensive to at least. Or that there's liability concerns and it's hard to get insurance. And maybe there's, somebody that's like, hey, I'm kind of scared to take this on if it's not the full thing that I do. And so what I tell farmers in my estate planning talks is to avoid probate with a revocable trust. Now, the website we're going to send you a link to has all sorts of information about that. And so we're not going to focus too many questions on that. Again, you'll have my email if you do have specific questions about it. And that will keep anything within that revocable trust outside of probate, which again is where most farms tend to get lost in the family lineage. And then avoid liability issues by putting your farm in an LLC. And typically the end goal here is you, as the owner of the farm, become a trustee of a revocable trust. That revocable trust owns an LLC, and the LLC is what owns the land. And so by doing that, you stay out of probate and you minimize your liability concerns. So a common topic to hit on because, again, estate taxes are not a concern that most farmers have. The last strategy that I'll hit on here, and it does look like we have time for questions, is business use of a farm vehicle. And so typically, any average business, for every mile you drive as a business owner or as somebody that's operating driving business miles per se, you get 70 cents per mile. That number is adjusted most every year with respect to inflation and specifically gas cost. But here, the IRS recognizes that farmers, specifically, can deduct, instead of having to track miles for their business use versus just dropping their kids off at school, the IRS is just like, hey, don't worry about keeping the records on this. Just 75% of your farm vehicle expenses are a qualified business expense. So any miles you drive, we're just going to say 75% is a clean number. And you might say, well, I'm using 80% of the vehicle as a business use. Well, yes, but how much record keeping do you want to have to do? This 75% tends to be a good round number for most farmers to use. And so takeaways from this, you're probably going to see a decrease in your income taxes based on this bill alone. Now, obviously, you may make a lot more in income. You might not have many deductions this year for your own personal reasons, but all things equal, changes from this bill should decrease your income taxes because there's lower income tax rates and there's a higher standard deduction and there's increases in other deductions. Farmers who have significant property taxes, like our beef and dairy guys, probably going to be using that higher SALT cap, meaning that you're going to be itemizing. If you're itemizing, that opens up avenues for other deductions. And so tax planning has become a lot more important than it has in previous years, where the standard deduction was more useful. Now, certain investments in tangible personal property, like your tractors, your combines, certain buildings, more incentivized now than they previously were because of bonus depreciation, because of Section 179. And lastly, estate taxes, the debate's kind of been put to bed for a little while, probably not an issue for most farmers. And so worry about other issues with your succession planning other than estate taxes. Again, this has been recorded. We'll post the recording. I know I talk really fast. Some people struggle with my southern accent. Sorry about that, but there will be slides that get posted, as well as the recording itself. We've got more than a few minutes for questions, so I may have talked a little fast, but I'll go ahead and take questions now if there are any.
Yeah, y'all are welcome to either come off mute if you like, and we'll deal with that chaos, or you can drop your questions in the chat. I don't see any in there right now, so while I'm waiting to see if anybody's got one, I Nicholas, could you talk just a real brief minute, since these are cattle folks and since we are selling and buying animals at pretty significant prices right now, particularly broodstock, and there's some rules around it, but how they fit into Section 179 and how the broodstock is business property, and so we don't always report. We would report the sales or revenue on 4797 versus a Schedule F. You want to touch on that a little bit? And then I did see one come in the chat. So y'all keep the questions coming. I got him kicked off.
Yeah, so I think I could pull up the chat on my end here. Yeah, I've got the chat pulled up, but I'll answer your question first, Brittany, because that has come up. Um, I was in Yanceyville last week, and they were talking about how expensive buying new cattle were, and they're like, we basically like we're scared to buy any right now because of how much it costs, but we're happy to sell some. And so, cattle, if you're a cash basis farmer, which is what most farmers are, this goes back to your accounting method. To break it down, you're either cash basis or you're accrual basis. And so if you're cash basis, the moment that income comes in, that is income for that year. If you're accrual basis, it depends on when the sale occurs. Like 95% of farmers, I think, are cash basis. If you're not sure, chances are you're cash basis. This is important because if you're cash basis and you're buying livestock that you're going to have longer than a year, like brood stock, then that is going to be a capital expense and you'll get to depreciate that year over year. And so you will be able to use Section 179 there. And if you're adding improvements to it, so any feed that you're adding to the cattle, any vet bills that are being added to the cattle, obviously that's kind of hard to apportion to one cow versus another cow. There are tools for that. Admittedly, there's better resources on that, and Brittany, I can find those and send those out. But you do need to be keeping up with basis for that because you'll need to be able to sell that off at some point, and that's how you'll calculate your capital gain on those cattle at that point.
Thank you. Yeah, there's some little nuanced rules too, but we get a lot of those type of questions. Like I'm pretty sure and this would be a ask your accountant question, but like even there are rules around if you're buying brood stock from a relative, like somebody within your family, that may or may not be eligible. But if it's a third party transaction, etc., you definitely want to make sure you're tracking where that keeping stock of that brood stock, so bulls and cows that you've purchased. Um, Animals that you've raised fall into a different category, but I knew that would, if it didn't come up, I thought it might. All right, well, we'll jump to Brent's question, and he's talking about income averaging.
Yeah, and just to finish answering your last question there, Brittany, like some of it depends on and this goes to Brent's question as well. Like the record keeping is the most important aspect of all this. And Derek does a really good job of this in NC Farm School, of emphasizing the importance of record keeping because if you try to just keep all this in your head, it's impossible, even for a small farm. And so I know a lot of folks use QuickBooks, but there's other softwares like FarmRaise. There's another I know her name's Laurel and she's doing a similar talk. She's got her own software out that uses Excel, and I think the Excel work is free that she does, but she has like handbooks too that you can go through. And not only are those good for keeping up with basis of cattle, it's also good for they'll actually calculate your Schedule F a lot of times. So definitely like record keeping is probably the most important aspect of all of this because there's a lot that goes into it. And to Brent's question, with income averaging, it really depends on the farm, but the IRS has specific rules about recognizing that farms can have really good years followed by really bad years. And so the IRS steps in and says, hey, we don't want you to have the most unpredictable cash expenditures related to tax expense every year. We'd rather you just say, hey, over 20 years, our income tax is going to be this. We're going to pay this much in taxes every year. Sometimes it'll be higher than we need to pay. Sometimes it'll be lower than we need to pay. Now, I'm being very broad here because it's farm specific. There's no like set rules of how much have you made in the past 20 years, and you're in this bracket as a result. It's very farm specific, and so it kind of goes to Suzanne's question there at the bottom of that is something you need to talk about with the CPA because they'll have to look at your specific farm income, where it may be going, and specifically where it's been too. It's one of those rules where it's not really great for new farmers because you don't have an established income average to work on. So you don't have a lag that you can work with. But it's something to definitely talk about, especially in years like this one where your income is going to be higher and you have to worry about paying taxes that are higher than you're normally used to. And so definitely go talk with the CPA about that because you want to make sure that you do it right because it's a very broad thing and you want to know like what have other people done in similar positions to me because it's not like a here's a calculator, just go punch it in. Um, Suzanne, I know Brittany's worked a little bit on this with trying to get professionals in general for extension to direct people to. I do not have a list of CPAs, but again, you have my email. Shoot me an email talking about where you're at because I know most folks are worried about getting a local CPA, and I will direct you to the nearest professionals that I know in the area. And if they're not useful, they can at least direct you to somebody who's more applicable to your needs.
I'm going to jump in and say one thing there too. We as extension folks can't recommend, this CPA over that CPA in your area. However, what we can do is access information about if there's a firm or an individual, either a CPA or certified tax preparer or an enrolled agent. Um, those folks who have taken NC State's Ag Tax School, which Nicholas will be in charge of in future years. But right now, it's all run through the McKimmon Center. But each year, maybe even a couple of times, but at least once a year, we offer a tax prep, sort of ag tax issues for tax professionals. And so we can get a hold of, or we have been able to in the past, get a hold of information about who may have taken that um, programming. That doesn't mean they're necessarily an expert in the area, but it does demonstrate that they've had interest, and they have gone to the trouble of taking a ag tax continuing ed course. So I would encourage you to reach out to Nicholas or through your local agent. They can reach out to us. I work directly with our dairy farmers and have oftentimes said, here's about 6 different entities in your area who have taken this ag tax school, and then it's kind of on you for exploring that as a relationship.
Yeah, and I appreciate the caveat there, Brittany, because I always try to make sure people know that it's not like a hard recommendation because we can't do that. But we always do for what it's worth. We try to reach out to the professionals to have good relationships with them so that we know um, we're making the community better, especially as I get in charge of ag tax school, and we can work with them and at least know some names to direct people to. Because I'll never send somebody to just one person. I'll tend to like list three or four. Um, and Suzanne, I'll read your question off here just so I can process it, not leave quietness on the screen for a minute. But for tax purposes, how should we set up things most advantageously if my husband and I own the land that our 19-year-old son will be farming? Y'all are helping with the land, or getting ready for cattle, helping with cost of fencing and other expenses. But at a point, all the other costs and revenues are going to be your son's. And so that's one of those things where it depends. I know that's not a fun answer to give a lot of times, but it depends in large part on when you and your husband bought the land and at what point you want your son to take it over. And so I'll give a couple extremes here. The first is if you and your husband just bought the land, like last year you bought the land, and you want your son to take it over in a relatively short amount of time, say when he turns like 25. And so during that amount of time, there's not going to be a huge amount of gain on the land. And so if your son ever decided, hey, I want that land across the county, we'll sell this part in 20 years, By giving it to them, you wouldn't be avoiding a huge shift in basis. But if it's a piece of land that your husband's, family gave to y'all right before they passed away, and their family members have given it to them right before they passed away, and you've got a significant amount of basis, distinction between the basis and what the fair market value is worth, and your son doesn't plan on taking it over until he's, say, in his 60s, well, that's one of those situations where we probably want to use one of those estate planning tools like a trust or a will to make sure that it goes to your son and gets that step up in basis. Because again, um, if you're in that situation, I'd probably say put the land in LLC. You and your husband should be trustees over that LLC. And then your son can be an employee of that LLC, but in reality, he's probably operating and making most of the decisions at that point, sort of like a manager of the LLC. Um, and so Suzanne, for those of y'all who can't see the chat, she said they bought the land 2 years ago and they plan to maintain ownership, but the son's going to be the operator. And so, yeah, that's kind of a hybrid in between the two extremes that I gave. If you bought the land 2 years ago and you plan to maintain ownership, that's great. So I would still recommend getting a trust and an LLC, putting the LLC in the trust and deeding the land to the LLC. You may have already done some of these steps, to be clear. Um, and then what I would do there is just say that when you and your husband pass away, your son gets the LLC, which owns the land at that point. And, you can have a handshake agreement with your son, essentially saying, like, hey, you're going to make all the decisions with this. Profits on the line for you, but for legal reasons, we're going to keep it in our trust and our LLC in the meantime. And if you need to make a change, he can buy you out. But no, there's going to be some estate tax planning consequences for that that are not super advantageous. And so I know family concerns can override this, but at least from a legal perspective, it'd be best if y'all kept it in your name until y'all passed away, and then your son could take it with a much higher basis than he would get now. And again, like this goes, like economists say the same thing a lot too. The really important part is to know this is just one thing to consider. And so if you're like, hey, this is not going to work with our family dynamic, that's you know this is just the legal and the tax considerations of it. But
All
that's a
right,
good question because a lot of people face that.
we got another minute if anybody's got a burning question. I see some extension agents, livestock agents on here too. So if you've got questions that you're commonly getting, you can throw those in. If we don't see any appear pretty soon, oh, there we go.
Shoot
That's
me an
Suzanne
email,
again.
Suzanne. I'll throw my email in the chat. It's on the screen too. Um, because I don't know her name off the top of my head. It's been a couple months since I met with her. Um, but I know her first name's Laurel, and she's out of Salisbury, I think. But she actually drove to Raleigh to come meet with us. She has a really cool handbook and software that she uses, or like it's not a software, but she has an Excel template. And I'm actually getting her to come talk to my accounting class because it's pretty neat how she does it. Again, not a recommendation. Check out Farm Raised and QuickBooks and others too. But that's just one that I've seen. And for the
Okay.
extension agents, if I can just say one last thing, I've been coming out to counties and doing tax talks, and so y'all feel free to shoot me an email, shoot me a call, preferably an email, because I'm not always in the office, and I can come out and do talks if you want me to talk directly to your folks.
All right, I'm going to say a great big thank you to Nicholas for giving his time this afternoon. Thank you for those that joined us. For those of you who made it through a recording later on, kudos. The next session coming up in the Dairy Winter Management Series is happening on November 13th, again at high noon. This one is much more focused on dairy, but we're looking at markets, trends, and opportunities where we've got some downward slide on milk prices. So join us at no at noon on November 13th if you're interested in that. Otherwise, we'll be circling back up in December for an in-person meeting. Registration information is still the same as what you had to register for this. So thanks for being here. I'm going to end the recording.